3,847 silver. When I first saw that number floating around financial Twitter, I did what most of you probably did. I laughed. I scrolled past it. I thought to myself, another crazy prediction from another person trying to get attention on the internet. Silver is trading at $84 right now. You're telling me it's going to 3,147? That's a 47x move. That's not a prediction, that's a fantasy. That's the kind of number that makes serious investors tune out completely. And honestly, that's exactly where I was 3 weeks ago. But then something happened. I kept seeing this number. It wasn't going away. And the person behind it wasn't some random guy on Reddit. It was Tavi Costa from Crescat Capital, a macro strategist with a real track record, someone who manages real money for real institutions. So I did what I always do when something doesn't make sense to me. I sat down, I pulled up the data, and I tried to prove him wrong. I spent the last 2 weeks going through every single assumption behind this 3947 number. Every ratio, every historical precedent, every piece of math. I was looking for the flaw. I was looking for the moment where I could say, there it is. That's where the math breaks down. That's why this number is ridiculous. I never found it. And I want to be very clear about what I'm about to tell you. I'm not saying silver is definitely going to 3,947. I'm not making that claim. What I am saying is that the math behind that number is not crazy. The assumptions are aggressive, yes, but the methodology is sound. And when I ran my own conservative version of the same math, I got a number that genuinely changed how I think about this market. By the end of this video, you're going to understand exactly how Tavi Costa arrived at 3,947. You're going to see where I agree with him, where I think he's being too aggressive, and what I believe the realistic range for silver actually is. Because spoiler alert, even my boring conservative worst case scenario still gave me a number above $400. And if you've been on the fence about precious metals, if you've been wondering whether you're too late or too early, this video is going to give you the framework to make that decision for yourself. Welcome to Finance Currency. I'm breaking down the hidden math behind markets every single day. If you're new here, subscribe, hit the notification bell, and if you can smash that like button, it genuinely helps this channel reach more people who need to see this information. Now let's start from the very beginning, and I mean the real beginning. Because to understand why someone credible is putting out a number like $3,947 for silver, you first need to understand the relationship between government debt and gold. This is the foundation of everything that follows. If you don't understand this, the rest of the analysis won't make sense. Here's a piece of history that most people never learned in school. During World War II, the United States ran up massive amounts of debt. We all know that. It was the most expensive war in human history. The government borrowed unbelievable amounts of money to fund the military, to build weapons, to support allies overseas. But here's what most people don't know. At the peak of that debt expansion, roughly 51% of all federal debt was backed by gold reserves. Let that sink in for a second. Half. The US government had enough gold in the vault to cover half of everything it owed. That gold backing, that discipline, that anchor is what gave the dollar its credibility during the most expensive conflict the world had ever seen. Lenders knew that even if the US was borrowing like crazy, there was real metal backing a significant portion of that debt. That's why the dollar was trusted. That's why people were willing to lend to the US government at low interest rates during a world war. Now fast forward to today. US government debt is larger relative to the economy than it was during World War II. We're talking about $35 trillion and growing, but the percentage of that debt backed by gold has collapsed. From 51% in the 1940s to roughly 3% today, 3%. The US still has the same gold, 261.5 million ounces sitting in Fort Knox and other depositories. Same gold, same vaults, but the debt has exploded around it. The ratio between what we owe and what we hold has gone from 51% to 3%. And this is where the first piece of Tavi Costa's framework comes into play. I want you to look at this chart because it tells the story better than words ever could. On your screen right now, you can see US gold reserves as a percentage of government debt going all the way back to 1920. See that spike in the 1940s? That's the 51% I'm talking about. That's World War II. That's when gold backing was at its highest. Now trace the line forward. It drops. It keeps dropping. But then something interesting happens. In 1980, that ratio spiked back up to 18%. And this is critical. It wasn't because the US bought more gold. We had roughly the same amount of gold we'd always had. The ratio spiked because the price of gold exploded during the 1970s. Gold went from $35 to $850. And when that happened, the value of US gold reserves increased so dramatically that the ratio between gold and debt improved, even without the government doing anything. Gold repriced itself to reflect the debt reality. That's the key insight. That's the foundation of everything Tavi Costa is arguing. Gold doesn't just sit there passively. In periods of debt stress, gold reprices upward to restore some version of that historical relationship. It happened in the 1930s. It happened in the 1970s. And Tavi Costa is arguing it's about to happen again, because right now that ratio is more stretched than it's ever been in history. 3% gold backing on $35 trillion in debt, and growing by $2 trillion every single year. The question isn't whether gold is undervalued relative to debt. The math is clear. It obviously is. The question is how much of that gap gets closed. And the answer to that question determines whether silver goes to $400, $1,000, or $3,947. Let me show you the math. This is where the big number comes from, and I'm going to walk you through it step by step so you can check my work. If the U.S. government's gold reserves were ever revalued to back 51% of current federal debt, the same percentage we had during World War II, the total value of those reserves would need to be approximately $17.85 trillion. I'll show you the calculation. Current federal debt is roughly $35 trillion. 51% of $35 trillion is $17.85 trillion. That's how much our gold reserves would need to be worth to restore the World War II ratio. Now divide that $17.85 trillion by the 261.5 million ounces of gold the U.S. currently holds. $17.85 trillion divided by 261.5 million equals approximately $68,000 to $75,000 per ounce. Gold at $68,000 to $75,000 per ounce. Now, before you close this video and write me off as insane, stay with me, because I'm about to show you why this number is actually the starting point of the analysis, not the conclusion. Tavi Costa uses $75,000 as his gold target for the extreme scenario, and when you apply a gold to silver ratio of 19 to that gold price, you get silver at $3,147. $75,000 divided by 19 equals $3,147. That's where the viral number comes from. That's the math that broke the internet. Now, is this realistic? Let me give you my honest take, and I want you to really pay attention here because this is where most analysis on YouTube falls apart. The math is correct. I checked it multiple times. $17.85 trillion divided by 261.5 million ounces does equal roughly $68,000 to $75,000. And a gold to silver ratio of 19 has been hit before in history. January 1980. It happened. So mathematically, the number checks out. But this is where I start asking harder questions because mathematical possibility and real-world probability are two very different things. First question, is 51% debt backing coming back? My honest answer, I don't think so. No government on earth is going back to a full gold standard. That era is over. The world runs on fiat currency, central bank credibility, and faith in institutions now, not gold bars in a vault. So using 51% as your baseline is the most extreme version of this calculation. It's the theoretical ceiling. It's what would happen if we completely reverted to 1940s monetary policy. But here's what I realized as I dug deeper. Even if you don't believe in the extreme scenario, the exercise isn't worthless. Far from it. Because watch what happens when I adjust this single assumption. What if instead of 51%, gold only backs 25% of federal debt, half of the World War II ratio? That gives you gold at approximately $37,000 per ounce. What if it only backs 18%? That's where we were in 1980. That gives you gold at approximately $26,000 per ounce. What if it only backs 10%? Barely above where we are now. Gold still needs to be roughly $15,000 per ounce. That's still a 3x from today's price. I made a table of these scenarios because I wanted to see them all in one place. Debt backing percent, gold price multiple from today, 51%, WWW, 75,000, 14x, 25%, moderate, 37,000, 7x, 18%, 1980, 26,000, 5x, 10%, conservative, 15,000, 3x. Look at that table. Even the most boring, most conservative scenario gives you gold at 3x today's price. And here's what that means for silver. If gold goes to $15,000 and the gold to silver ratio compresses to even 35, not the extreme 19 that Tavi uses, just 35, silver would be approximately $428. $428 silver on a conservative estimate, using the most boring assumptions I could come up with. That's when I started paying very close attention. Now let me show you the second piece of evidence that supports this framework, because the debt to gold calculation isn't the only thing pointing in this direction. There's a completely separate analysis that arrives at similar conclusions through a totally different path. It's called the Dow to gold ratio, and it's one of the most powerful charts in all of financial analysis. The Dow to gold ratio is exactly what it sounds like. You take the Dow Jones Industrial Average and divide it by the price of gold. When this ratio is high, stocks are expensive relative to gold. When it's low, gold is expensive relative to stocks. And this ratio has a pattern that has repeated 3 times in the last 100 years. Every single time it reaches an extreme, it reverts without exception. The ratio peaked in 1929, right before the Great Depression. It crashed. It peaked again in 1966. It crashed all the way through the 1970s until 1980. It peaked a third time in 1999 at an all-time high of 44.8, the dot-com bubble. Peak euphoria. Stocks were more expensive relative to gold than at any point in recorded history, and since 1999, it's been falling, with a failed rally in between that tricked a lot of people. Right now, the Dow to gold ratio sits at approximately 9.5, and here's the part that made my jaw drop. In 1973, right before the biggest gold and silver bull market in modern history, the Dow to gold ratio was at roughly the same level, around 10. From there, it fell all the way to 1 by 1980. Gold went from $180 to $850, a 4.7x move. Silver went from $6 to $50, an 8x move. The pattern has repeated 3 times in 100 years, and we're sitting at the exact same starting point as 1973. I want that to sink in, because this isn't some obscure indicator that only works sometimes. This ratio has a 100-year track record of calling major turns in gold and silver, and right now it's flashing the same signal it flashed before the greatest precious metals bull market in history. Tavi Costa uses a target of 2.5 for the Dow to gold ratio. Not 1, which was the extreme low in 1980. He's not trying to call the exact bottom. He's aiming for the middle of the move. And I actually respect that approach, because trying to catch the exact bottom is how you get destroyed in markets. So let's run the math with his 2.5 target. If the Dow stays roughly where it is today, around 49,500, and the Dow to gold ratio drops to 2.5, that implies a gold price of approximately $19,800. The calculation is simple. 49,500 divided by 2.5 equals $19,800. Now, I want to stress test this, because I don't just accept other people's numbers. I run my own scenarios. What if the ratio only goes to 5 instead of 2.5? More conservative. That gives you gold at roughly $9,900. Call it $10,000, still a double from today's price. What if it goes to 3.5? That's gold at approximately $14,000, almost 3 ikas from here. Dow gold ratio target implied gold price multiple 2.5, Tavi's target 19,800, 3.8x, 3.5, moderate 14,100, 2.7s and 5.0, conservative 9,900, 1.9x. Every single scenario shows gold moving significantly higher. The only debate is how high. And here's something critical that most people miss. The assumption that the Dow stays flat is actually reasonable. It might even be conservative. In the 1970s, the stock market went nowhere for an entire decade. The Dow's low point came in 1973, and by the time gold peaked in 1980, stocks had barely moved. The Dow was essentially flat for 7 years, while gold exploded 4.7x and silver exploded 8x. Why? Because stocks don't perform well in inflationary high-debt environments. They struggle. And what do we have today? Inflation is sticky. Debt is exploding. Geopolitical tension is escalating. Interest rates are elevated. That's not an environment where stocks rally 50%. That's an environment where stocks chop sideways while gold and silver reprice against them. Now, there's something Tavi Costa said that I think most people skimmed over, but it's actually the most important part of his analysis. He said he doesn't believe the real bottom in the Dow to gold ratio was set in 2011. And when I looked at the data, I realized he's right. In past cycles, the Dow to gold trough coincided with debt becoming manageable again. In the 1930s, debt was wiped out through deflation and defaults. In the 1970s, debt was wiped out because inflation destroyed the real value of what was owed. Both of those processes were brutal for paper assets. Both were incredible for gold and silver. But here's the thing. Neither of those processes has happened in this cycle yet. After 2011, did global debt stabilize? No. It exploded. Every major economy printed money like there was no consequence. The Federal Reserve's balance sheet went from $2 trillion to $9 trillion, government debt doubled, corporate debt tripled. If the historical pattern requires debt to become manageable before the Dow to gold ratio bottoms, then 2011 cannot be the bottom, because debt is bigger today than it was then. Significantly bigger. That means we're not starting a new cycle. We're in the middle of a cycle that began in 1999 and still hasn't completed. Think about that for a second. The move we're seeing now in gold and silver isn't the beginning. It's the continuation of something that's been building for 25 years. That changes everything about how you think about price targets. Now let's talk about silver specifically, because this is where it gets really exciting and really controversial. The third piece of Tavi Costa's framework is the gold to silver ratio. This is the number that determines how much silver outperforms gold during a precious metals bull market. Right now, the gold to silver ratio is approximately 60.7. That means 1 ounce of gold buys you about 60 ounces of silver. This ratio has been as high as 125 during the COVID crash in March 2020. Extreme fear. Everyone rushing into gold, silver getting ignored, and it's been as low as 14 in January 1980. peak precious metals mania, the Hunt brothers trying to corner the silver market, silver exploding faster than gold. Tavi Costa uses a target of 19 for this ratio. His reasoning is that 19 is conservative relative to the 1980 low of 14. He's not using the extreme, he's using a level above the extreme. And this is where I have my first real disagreement. I want to be transparent about it. A gold to silver ratio of 19 has only been hit once in the last 50 years. Once, in 1980, during an extremely unusual situation where two billionaires were actively trying to corner the silver market. Before that, you have to go back to periods when silver was an official monetary metal used in daily circulation. Dimes, quarters, half dollars, all made of silver. Today, silver is not a monetary metal. Central banks don't buy it. They don't hold it in reserves. It's primarily an industrial metal with investment demand on top. Does that mean the ratio can't compress? No, it compresses in every single precious metals bull market. That's a fact. But does it compress all the way to 19? That's a big assumption, and I think it's the most aggressive assumption in Tavi's entire framework. Let me show you what I think is more realistic. In the 1970s bull market, before the Hunt brothers distorted everything, the gold to silver ratio naturally got down to about 30 to 35. That was organic market action, no manipulation, just supply, demand, and investor preference. During the 2011 silver rally, it got down to about 31. Again, no unusual manipulation, just a normal precious metals bull market. So a range of 30 to 40 is where this ratio naturally wants to go during a bull market without extreme speculative events. Now watch what happens to the numbers when I adjust this single assumption. Let me run through the different scenarios using the Dow to Gold implied gold price of $19,800. Tavi Costa's version, gold, $19,800. Ratio, 19. Silver equals 142 That's his number. Aggressive but mathematically sound. My conservative version, gold, $19,800. Ratio, 35. Silver equals 566. I looked at that number and thought, okay, that's more grounded. But then I realized 566 silver is still a 6.7x from here, on a conservative estimate. My moderate version, gold, $19,800. Ratio, 25. Silver equals 792. That's almost 10x from today's price. Even more conservative, gold, $15,000. Ratio, 35. Silver equals 428. I deliberately made every assumption as boring as possible, and I still got over $400. Scenario gold price, GS ratio, silver price. Multiple Tavi's bull, $19,800, 19 to 1,342, 12.4x. Moderate bull, $19,800, 25, 792, 9.4x. Conservative, $19,800, 35,566, 6.7. Very conservative, $15,000, 35,428, 5.1x ultra. Conservative, $10,000, 40, 250, 3.0x. That table changed how I think about this market, because even the ultra-conservative scenario, where I'm basically trying to lowball everything, still gives you silver at $250. That's a 3x. Now, I need to address the bear case, because if I only showed you the bullish math, I'd be doing you a disservice. And honestly, I'd be the same as every other hype channel on YouTube. That's not what finance currency is about. There's a smart argument against all of this that I saw in the comments section of Tavi Costa's original post, and when I read it, I paused, because the person made a point that deserves a real answer, not a dismissal. The argument goes like this. Tavi Costa ignores the supply side. As silver prices rise, mining becomes more profitable. More silver gets produced. That increased supply pushes the price back down. Silver is a commodity. It responds to price signals. You can't just extrapolate ratios without accounting for the fact that higher prices create their own ceiling. It's a good argument. Classic economics. Supply and demand. The person also pointed out that silver is a purely industrial metal today, not a monetary metal. You can't put gold and silver on the same level because central banks buy gold, but they don't buy silver. These are valid points. And I'm not going to pretend they're not, but I am going to challenge them with data. Let's start with the supply argument. If higher prices cause higher mining output, which causes prices to fall, then why didn't that happen in the 1970s? Gold went from $35 to $850. That's a 24x move. Silver went from under $2 to $50. That's a 25x move. Mining activity did increase during that period. New mines were opened. Existing production was expanded, but it didn't matter. The demand side was so overwhelming that supply couldn't keep up. Why? Because opening a new mine takes 7 to 10 years. Permitting, exploration, development, construction, it's a decade-long process at minimum. Expanding existing production takes 3 to 5 years. You need new equipment, new workers, new processing facilities. The supply response is slow. The demand surge is fast. By the time new supply comes online, the price has already moved. And I want you to really sit with that for a second, because this is the part the bears never have a good answer for. In the last 100 years, there have been two major periods where excessive debt was effectively wiped out. the deflationary collapse of the 1930s, the inflationary explosion of the 1970s. Both were catastrophic for paper assets, both were incredible for gold and silver, and in neither case did increased mining supply prevent the rally. The macro force of debt repricing overwhelmed the micro force of increased production. It wasn't even close. Now look at what's happening today. Silver has been in a supply deficit for 5 consecutive years. 5 years. The price has tripled from its 2020 lows, and we still can't get enough silver. Refineries are backed up until April. Mints aren't taking new orders. The largest bullion dealer in Singapore reported 8-hour queues. COMEX vaults are draining at 20 million ounces a month. If higher prices solve the supply problem, it would be solved by now. It's not. And it won't be solved for years, because the mines that need to be built to close the deficit haven't even been permitted yet. That's the reality the bears don't want to acknowledge. You cannot mine silver that doesn't exist any faster than you can create gold that doesn't exist. Geology doesn't care about economics. Now, the monetary metal argument, this one is more nuanced, and honestly, the bears have half a point here. Silver is not a monetary metal today. Central banks don't buy it. That's true. And that means silver doesn't get the same sovereign bid that gold gets. Gold has central banks buying 2,500 tons a year. Silver doesn't have that buyer. But here's what I think the bears are missing. Gold wasn't really a monetary metal in 1971 either. Nixon had just taken the U.S. off the gold standard. Gold was being actively demonetized. Central banks were sellers, not buyers. The U.S. government was telling everyone that gold was a barbarous relic. And gold still went 24x in the next decade. Silver still went 25x. The remonetization argument works in retrospect, but it wasn't the driver at the time. The driver was debt, inflation, and loss of confidence in the currency. Sound familiar? And there's something else. Silver may not be monetary today, but it's strategic. The U.S. government added silver to the critical minerals list in 2023. That's not a monetary designation. That's an industrial and military designation, which arguably makes it more important than being monetary. You can survive without silver coins. You cannot build solar panels, missiles, electronics, or medical equipment without silver. Industrial demand is growing, not shrinking. And here's a question I'd turn back on the bears. Central banks aren't buying silver yet. What happens to the price when they start? Let me give you my honest framework. And I want to start with the risks, because I'd be lying to you if I said there were no scenarios where this thesis fails. That's not how markets work, and that's not how I think. Risk number 1. Central banks successfully bring debt under control without a currency crisis. If governments somehow manage to cut spending, reduce deficits, and stabilize debt to GDP ratios without causing a recession, the pressure on gold to reprice diminishes significantly. I think this is extremely unlikely given the political environment in every major economy. Nobody wants to cut spending. Nobody wants to raise taxes enough, but it's possible. Risk number 2. A severe global recession crashes everything, including precious metals, temporarily. In 2008, gold initially dropped before it rallied. Silver got crushed. If we get a liquidity crisis where everyone sells everything for cash, silver could take a significant hit in the short term, even if the long-term thesis is intact. Risk number 3. Technology disrupts silver demand. If someone invents a silver substitute for solar panels or electronics that's cheaper and equally effective, the industrial demand pillar weakens. I don't see this happening in the next decade, but dismissing it entirely would be intellectually dishonest. Now, with those risks acknowledged, here's what I actually believe. Tavi Costa's directional thesis is correct. Gold is deeply undervalued relative to debt. The Dow to gold ratio suggests we are at the beginning of a major repricing cycle, and silver will outperform gold during that cycle because it always does when these ratios compress. His gold target of $19,800 is within the range of possibility if this cycle mirrors the 1970s. The math works. The historical precedent supports it. Where I disagree is the gold to silver ratio target of 19. It's too aggressive for a base case, not impossible. But I'd use 30 to 35 for a conservative estimate and 20 to 25 for an optimistic one. And the $3,947 silver number? That's a theoretical ceiling, not a realistic target. It requires both the most extreme debt backing scenario and the most extreme ratio compression happening at the same time. Could it happen? Mathematically, yes. Will it? I wouldn't bet on that specific number. But here's what I would bet on. Even using my most conservative assumptions, silver comes out above $400. Using moderate assumptions, it comes out between $500 and $800. Using optimistic, but not extreme assumptions, it breaks $1,000. The timeline matters too. Tavi Costa's analysis points to 2030 to 2033. This matches the 1970s pattern, where the Dow to gold ratio took about 7 years to move from the zone we're in now to its final low. This isn't a next month call, it's a multi-year thesis, and I think that actually makes it more credible, not less. Let me put this in perspective. Because I know numbers like $400 or $1,000 silver sound abstract. Silver is trading above $84 today. If it goes to $400, that's almost a 5x. A $10,000 position becomes close to $50,000. If it goes to $600, that's roughly a 7x. $10,000 becomes $70,000. If it goes to $1,000, that's almost a 12x. $10,000 becomes nearly $120,000. These are life-changing returns, and they don't require the extreme 3,247-hour scenario to play out. They just require the same thing that's happened in every precious metals bull market in the last 100 years. Ratios that are stretched to one extreme swing back toward the other. The people who bought gold in 1973 at $180 were told they were crazy. Gold had just been demonetized. The government said it wasn't money anymore. Mainstream economists called it a relic. 7 years later, it hit $850. The people who bought at $180 made almost 5x. The people who waited until it was obvious missed most of the move. We're sitting at that same 1973 moment right now. The Dow to gold ratio is literally at the same level. The debt situation is actually worse. And the crowd is still skeptical. 2 ratios, 100 years of history, both near extremes. Both have reverted in every historical cycle. And if they revert even partially this time, silver goes to levels that most people today would call insane. Just like people in 1973 would have called $850 gold insane. It happened 7 years later. I want to leave you with one thought that genuinely keeps me up at night. The entire precious metals market, gold and silver combined, is tiny compared to global debt. Total above-ground silver is worth maybe $200 billion at current prices. Global debt is over $300 trillion. That's a 1/500 to 1 mismatch. When even a small fraction of that debt reality gets priced into precious metals, the moves are not 10% or 20%. They're multiples. The math isn't complicated. The pool of metal is small. The ocean of debt is massive. And the dam between them is cracking. There are catalysts that could accelerate this faster than the 2030 to 2033 timeline. A currency crisis in a major economy. A sovereign debt downgrade of the United States. A sudden loss of confidence in the dollar as the global reserve currency. A major central bank announcing silver reserves for the first time. Any one of these would compress the timeline dramatically. You wouldn't need 7 years, you might need 2. And the thing about these catalysts is that they're not fantasy scenarios. They're the logical conclusion of the current trajectory. When you're adding $2 trillion to the national debt every single year, eventually the math catches up. The question isn't if, it's when. And when it does, you don't want to be the person who looked at the Dow to gold chart, understood the pattern, and still didn't act. I'm not telling you silver is definitely going to 3,947. I'm telling you the math behind that number is not crazy. The assumptions are aggressive, but the direction is supported by 100 years of data. And even the most conservative version of that math puts silver multiples higher than where it trades today. 2 ratios, 100 years of history. One conclusion, silver's biggest move is still ahead of us. Drop a comment and tell me which target you think is realistic. $400, $600, $1,000? Or do you think the bears are right and supply will cap it? I'll pin the best responses from both sides. If you found value in this analysis, share it with someone who thinks $3,140 silver is crazy. Show them the math, then let them decide. Subscribe to Finance Currency if you want more deep dives like this. I'm decoding the hidden math behind markets every single day. This is Finance Currency. Stay sharp, stay stacking.